Good morning, good peoples. Well, either late evening or early morning for you guys. Already into my Friday. All right, let's jump in. This one is people keep wanting to get paid. So is the next big thing daily? Personally, I don't even want to get paid daily. Weekly is nice. Couple times a week is better. I think there's just too much cost involved with daily. That's my gut, guys. All right. So Defiance, that probably rings alarm bells for some of you because they're good in some aspects, but a lot of their income funds, NAV erosion. All right. So they have filed, you're looking at my screen, they have filed for biweekly payers 2 times a week. Okay, it's not a 2x leverage. It's 2 times a week or better. I think it resonates with us better to say biweekly. Okay, the prospectus I have for you to take a look at. This is kind of a summary. So let's go do that. So this is filed Defiance ETFs, Defiance NASDAQ 100 Lightning Spread, a trademark name they're utilizing. QLDY is the proposed symbol. And then on the S&P, so very similar to their, I think in Roundhill, because I know those the best, right? XDTE, QDTE, and RDTE. Those are the ones that stick out in my head. So NASDAQ, Spider, S&P 500, and the Russell 2000. So what do these consist of, and what do you mean twice a week or biweekly? Well, kind of what it says, right? Let's walk through this a little bit and then I'll flip back to mine. Let me go back over there and then I'll come here. All right. So that's the funds that they showed you. They carry a 0.99 and a small, other charge. So 1.044. So not the 128 that you see on some, right? But still 1%, whereas some income ETFs are, in the big guys that are conservative and yield 10 or 12%, you can get those sometimes for 0.4, 0.5, 0.35. So a lot of people look and say 1% is expensive, but I think those of us in the high yield realm are used to seeing, 1% is sort of the threshold for most of the 0.99, but all right. So the filing date is May 23rd. So let me tell you my experience here. I've listened to Jay, I've talked with other and interviewed other CEOs, and so there's a handshaking process. They file, okay? If there's any question, okay, on the SEC side of it, those regulators will reach out. They have phone numbers, they have emails, and they'll dialogue and say, well, I don't understand. You said that. What exactly do you mean? Can you re-clarify that and give us a little more depth? And so then you send over a new paragraph. Or they say, okay, did you understand this? So any small dialogue adds a day or two. And then sometimes you have to take more action. So I would say the earliest these typically come out is 60 days and typically the longer ones are 75 days. Now, remember, sometimes these things get approved and the fund family, in this case it's Defiance, may choose not to launch on that date. Maybe the markets have turned bearish. This is clearly a bullish bet on the index. If you encounter a downturn in the index, you'll see NAV erosion on steroids. Okay. So again, most of the income funds, even though they do it differently, and I'm going to explain how they do it differently. So I just went out 60 days and said, okay, July 23rd to August 7th. Okay, this is my ballpark. Let's see how it turns out. All right. So what is this? All right. So there's zero DTE. If you guys don't understand, I think now if you've been in Roundhill, you've been in some of these who kind of pioneered the weekly payers, right? If you understand that, that means that you do an option, you write it, whether you buy a call, sell a put, use a spread, whatever you're going to do on your options, you do that within a single day. Often you execute the trade after the market opens, and you can buy it back at any point in time. If you use the put spread, which is what they're intending to do, you do better, okay, when it's above the bought put, right, or the sold put, which is the higher put value. I'll get into that in a minute, but just remember it's a bullish bet because if it goes down a fair amount, you go down. You know, you're limited to the spread difference between the sold put at the higher strike price and the bought put at the lower strike price. So if you choose a $3 and then you put that into percentage, but if you choose a $2, $3, $4, $5 difference, that becomes what your loss is limited to. But still, that can be substantial. And let's talk about what they do on a synthetic. It's not the same as you guys that have listened to me and other YouTubers talk about synthetics on YieldMax and even now on a lot of the other funds that have sort of copied YieldMax is synthetic, although many now are moving to the swap so that they can get leverage. But let's stay on the synthetic for a second. So how many of you know what the synthetic consists of in a YieldMax typical fund? Okay, it's a bullish bet, but it's got two components, correct? They buy a call and they sell a put, both positive actions. If you bought the put, you would be betting bearish. If you sold the call, it's sort of bearish because you don't want it to go, right? But in their case, they're buying, normally in those YieldMax funds, they're buying the call and selling the put. So it's their essential long strategy that gives them maximum long exposure, and then they sell credit spreads, call credit spreads to try and produce income. Okay, this particular fund is buying deep in the money call options, so that synthetic is a bullish bet, but they're not also, if you will, selling puts. And remember, these may be out 3, 4 weeks, 6 weeks, similar to what, you know, the YieldMax funds are doing. So this is a bullish bet, but it's a single bullish bet. It's not a dual bullish bet, but it's plenty. And that's because they're getting out of each of their ODTE every day. So they sell bull put spreads. Okay, what the heck does that mean, right? Well, it's, and I can pull their sheet over and show it to you, but I know this stuff really well, so it's easy for me to explain here, and then I'll show you they run through some examples. So they sell a higher strike put, probably right at the money, maybe slightly in the money. You know, that's their strategy and secret sauce that they'll play with. Okay. And then they come in and buy, remember, this is all for 1 day outcome, buy a lower strike put. So you have some protection. And so the difference, if, you know, I'm making it up, an index doesn't trade at 100, but let's say an index trading at 100. So they sell a $100 put, and then they buy a $97 put. Okay, so they had to spend money on that put, but they're going to spend less than what they're able to sell the at the money put, because that's more at risk, right? The 97, you know, you're not going to pay as much for it because it's got to drop $3 before the thing starts to make any money. Okay, so they've collected whatever the premium difference is, don't confuse the strike prices with the premium. Let's say they've collected $1.50, $2. We'll use $2. And then they got this spread of $3. Well, if the thing goes down, they're limited to whatever the spread difference is. Say it's $3, they can have a $3 loss there. And then remember, when it goes down, this deep in the money call loses the same. It loses that 3%, right? So that synthetic, one element synthetic goes down, and so does the strike. So you want it ideally to stay above. You want it to stay at 100 or 100.10 or 101. You want these to stay up here. So you keep the premium. You keep that $2 that I mentioned to you in premium. And every day, if you collect premium, it's never going to be every day. You're going to have some losers in there, but you want to have more winners than you do losers. And then if the thing, and remember, they say it's a 1 day, but honestly, if some news comes out and it's an hour into the markets and the index rises a lot, okay, they keep the upside on that put, and I mean, sorry, on that long synthetic, that deep in the money call, they're making all that money. And I guarantee you, they're simply going to take the spread off, right? Because it's going to be above that. They may wait till an hour before expiration or, some period. And they're experts in options and managing that. And so then you collected your premium and your synthetic made money. So you can read out and see when this fund launches, they're going to have all this stuff on their prospectus. All right, so I don't need to tell you what all the things are. The other thing, this is kind of interesting because let me explain to you. When you have a yield max type fund and you're not on an index, in other words, you're on a single stock. This applies to um, Roundhill on all their single stock, their current 5 launch single stock, right? The NVIDIAs and the um, uh, PLTW, the NVDW, TSLW, COIW, all those guys. You have to utilize options and or swaps and keep that money that you utilized under 25%, because an ETF, by definition with the SEC, you cannot deploy more than 25% of your funds in a single security. So how do they get away with it? Well, they use options, and maybe they use 12% or 18% of the funds, and they get a lot of leverage, and they make their money, and they park all the other money in cash, and they didn't break the SEC rule. It's kind of a sneak attack on it, right? All right. So they're targeting to use 80% of the funds. That's way different than we're used to seeing. But when it's on an index, they don't have that because the index is made up of so they don't consider an index a single security, right? It has to do with what that index holds. The other thing is taxation. I want to bring that up toward the end. That I didn't read in the prospectus, and I think they're missing something here. Okay, so the income comes from the spreads when successful, and of course, selling the deep in the money calls, occasionally enrolling to a new expiration date and perhaps a different strike price if it's moved up. So people think it's only from the from the dailies, and that's considered the primary source. But if they build up cash in this thing, they can roll it. So, and I imagine they're going to go out 4, 6, 8 weeks on these guys when they launch. How about pay dates? What are you guys thinking? Okay, they say they're going to pay bi-weekly. So I tried to think this thing through, and I interested. Hit me up with comments, suggestions. Not that we're going to change what Defiance is going to do. My guess is whatever one of the days that they're already paying, very likely will be one of the days here, so that the company they're already set up with that does the actual payments, and that's those big firms that do that stuff for all these fund families. Unless you're Vanguard or some big giant, when you have an in-house group that does that. But when you're a Defiance or I suspect Yomax still, you're using a firm that does that for you and charges you. Okay. So I don't recall them right now, but I think it's Friday paydays. I know Yomax is Friday, but whatever it is, I would think Defiance is going to go there. My thoughts would be a Tuesday and Friday would be cool. Okay. So then you have a ex dividend date on a Monday and a Thursday. So you always want like 3 days apart, but you're still going to get short and going around because when they pay you on Friday and then paying again on Tuesday, you're shortened on that. But they'll tell us, is it a Monday, Thursday? Let them. But my guess is if they can use an existing payday on other funds that they have, that cuts down. That means only one new day, not two altogether new days, which I think would be more work for the company, Fireside or whoever they utilize for that. All right, guys, that's kind of what I had. Let me see if there's anything when I peruse through this. Um, there's a lot of info, but most of it's the typical warnings and, all that kind of stuff. Portfolio holdings, management, how to buy and sell shares. You know, oh, so on their distributions, they talk about taxes. But one of the things, and I just put out something that reminded me, most of these people who trade options on indexes, the funds, as I understand it, qualify for Section 1256, which is a almost done, it's contracts and straddles and futures, mark to market type things where you're able to take that distribution when it's not ROC and it's just a taxable, and you're able to say, okay, 60% of the distribution is going to be taxed at long-term rates and 40 at short-term. Well, short-term essentially is ordinary income rates. Okay. So I didn't see here a reference to that. But again, did I read every single thing? And maybe that's just they didn't think to that level. I don't know. Otherwise, I don't even think they brought up ROC. Oh yeah, Foresight. I was Fund Service is their fund distributor. What did I say? Fireside. So Foresight. Premium discount. Yeah, I don't know. I think I hit you with enough. Guys, maybe this doesn't get approved. My sense is it will. I don't think the SEC has got any burrs, or any real issues with these things. I think it's the highly leveraged that they don't necessarily like getting into 3x. Although I do, buy sometimes in swing trade GDXU, which is a GDX 3X leverage. But those are few and far between, but you do have some out there, especially on the indexes. You see that sometimes. All right, guys, this is Bruce with Targeted Wealth Creation. Hopefully, this was helpful to tell you. And look, if Defiance gets this done, many more will follow. I guarantee you, nobody wants to be outdone. I mean, Roundhill was the innovator with the weekly pay, and look at how many are doing that now. Although other people are holding the edge and still going monthly. And then you saw the swap and the leverage, and you saw, MST with 150 to 200% leverage. All right. All right, guys, this is Bruce with Targeted Wealth Creation. I'm not a financial advisor. This is not financial advice. Have a great one. Bye for now.